Hey everyone, welcome back to Arcadia Markets. Today, I want to zoom out and look at a slow trend that doesn't move the market in one day, but quietly shape US stock over many years. The world is getting older, people are living longer, having fewer children, and in many major economies, the working age population is shrinking, while the retired population keep growing. Japan is already there, Europe is close, China is moving in that direction, even the US is aging just a bit slower because of immigration. So, what does an aging world means for US stock? Let's break it into 3 simple points. First, more demand for healthcare and stability. As people age, they spend more on doctor, hospital and medicine, medical equipment, nursing, home care. That supports healthcare companies over the long run. Drug makers, medical device makers, insurers, and health service providers. At the same time, older investors usually care more about steady income, smaller swing in their portfolio, and protecting their retirement money. So, dividend stocks, utilities, and solid cash flow businesses can stay in demand, especially for global investors who see US assets as a safe base. Second, more pressure on story-only growth. When more investors are saving for retirement, they are less willing to chase very risky, very long-term ideas with no profit today. That doesn't mean growth stocks are dead, but the market become more picky. Investors want to see healthy finances, a real plan to make money, and not just believe this will be a huge in 15 years. High quality growth can still do well, but weak or overhyped stock may struggle if big pool of money start to prefer safer, income-focused ideas. Third, more worry about government debt and interest rate. An older population usually means more pension costs, more healthcare spending, fewer workers paying tax. That can lead to higher government debts and more pressure in the bond markets. If investors start to worry about long-term deficit, they may ask for higher yields to buy government bonds. For US stock, that matters because higher yields are a headwind for very expensive growth stock, but they can help banks and some financials that earn more when rates are higher. So, if you believe the aging world trend continues, here are 3 areas to keep on your radar. First, healthcare, drug, device, services and insurance. Second, income and stability, dividend stock, utilities, and solid boring businesses. Third, selective growth, companies that still grow but already have real earnings and strong balance sheet. Big picture, this is not a one-week theme. It's a slow backdrop that will sit behind markets for the next 10, 20, even 30 years. If this helps you connect demographic change to what you see on your US stock screen, hit subscribe for more clear, simple market breakdown. This is Arcadia Market. See you in the next episode.